Okay, everyone tells you that the hardest thing about buying a condo is your credit score. Totally wrong. You could have done everything right. Your income is strong. Your credit is pristine. You've saved the money. You spend very well every month, but you could still get told no. And the reality is, because it's not just you, you need two approvals, your approval and the building approval. And most people don't even find out until the deal is falling apart. So if you're thinking about buying a condo, maybe it's your first place, maybe you're downsizing, maybe you have a big life transition, like your career moved you to a new market, or maybe you just got divorced and you're starting over again. I just want you to hear this before you fall in love with this place. The building you don't control by people you have never met can totally cost you the home you've already picked out. My name's Tammy, 20 plus years in the mortgage industry, helping over 2,500 homebuyers across the United States. Yes, I've had to have the hard conversation, walking clients through one of the biggest financial conversations and decisions of their life. I'm not guessing. I've had to have the hard conversations too. The one where you did everything right and the building is the one I can't get approved. So here's what I promise you. By the end of the video, you're gonna know that it's really two approvals, not just one. And I also want you to know that things changed here in 2026. So I want you to go in eyes wide open on this. And there could be one big surprise that your home inspection won't show up. Plus the exact questions to ask before the closing table. I call it buying the building, not just the unit. Number one, you're not just buying one unit. You are buying the whole building. So we have to approve you and approve the building. And there's things we're going to be asking about the building. Remember, you could totally ace your half of it and lose on the other side. Here's what very few lenders actually explain. There's a word that lenders use: warrantable. It means that the building follows the rules that the large mortgage backers set. We check all the real things: how much money the building keeps in reserves, how many unit owners are behind on their dues, whether one person owns too many units, how many people live in the building versus how many people rent units in the building, whether there's a lawsuit hanging over it. And here's what catches people off guard. You could have done everything right, but if the building has one of these red flags, that can totally throw a wrench into things and now make this building non-warrantable, which there still are options for it, but we need to ask more questions. And you want to know the answers to these questions as well. Now remember, you haven't done anything wrong, and you can't see these situations kind of behind the curtain. You don't know these situations going on when you saw the kitchen counter, when you saw the view. So these are just really good things to ask more deep questions about. Let me just reposition this a little bit for you. You're not just buying one unit. You are buying the financial situation of the entire building, the balance sheet of that building. Remember, the building's money problems do become a situation and potentially your own money situations. Remember, say that back to yourself. When you buy the unit, you're also buying the financial situation of that building. And this isn't like a glitch thing. So Fannie Mae has a list. And remember, Fannie Mae is one of the major mortgage backers. They have a list of approved condominium buildings, but they also have a list of unapproved condominium buildings. There could be so many reasons that a building is on the unapproved. And it's not to say once you're on that, you can't get back to the approved list, but don't you want to know all the things going on in the association with that building before you purchase, before you marry the building? So it's really good for you to ask, whether it's your real estate professional or me, your mortgage professional, is this building warrantable? Is it on Fannie Mae's warrantable list, approved list? Do you know? Now, you may have asked the question and they said, yep, it's on the approved list. I'm good, the building's good, so I'm fine. But wait, some things changed this year in 2026. What was approved last year may not be approved this year because some ground rules changed. And nope, no one sent you the memo. So in 2026, the rules changed for condominiums. Do you remember a few years back, a building collapsed in Florida? And because of that, the mortgage backers tightened the screws when it came to condominium buildings. Because what they found is that some of the associations, which is who oversees the finances of that condominium building, weren't saving enough to fix the items that needed to be taken care of. Everything needs fixing over time or enhancing, and you need money to fix those items. So now the rules are more strict. as they should be. It's for everyone's safety. Now, why does this land on you? Because you're the buyer. And so anything the building has going on, if you're purchasing, you need to know, is this something you will have to fund? Maybe with a higher monthly assessment. Don't you want to know that now, what's coming? Because if the building ignored funding repairs for almost 20 years, two possible things can happen. Number one, your HOA dues could totally increase. And number two, the building's approval status can completely flip as you're buying this place. So here's your move. Ask for a couple documents. Ask for the reserve study. It's done every few years within a condominium building. And then also ask for the last 12 months of the HOA board minutes. And what the minutes are, they're the notes taken in the monthly meeting of all the things they're talking about. And you're not reading it like you're an attorney, but if you are, you have a leg up on us. You're really reading it and you're looking for two phrases. Number one, underfunded reserves. And number two, deferred maintenance. Usually those two phrases are the smoke before the actual fire. If you see them, just ask for more information. Is there something that we're expecting coming on? Should we be concerned? Are we not allocating as a building enough for future projects? And if you're sitting there thinking, oh my gosh, I'm just trying to buy a home. This is a lot to think about. That's fair. That's why you have professionals like me and your real estate professional so that you are purchasing a great unit. Remember, you're buying in the building, so you're buying the building situation as well. If you're thinking, this is a lot to keep track of, Tammy, that's fair. And that's exactly the kind of thing I check for my buyers before they put an offer in, which brings me to something real quick. If you just put an offer in on a condo and your stomach is cringing right now, I don't want you to go through the rest of the process thinking this. Reach out to me. Let me know the association name. I'll look it up for you. I'll let you know what I can find in the internal databases to kind of ease your anxiety. I don't want you to walk through the rest of this. Reach out. Okay. Number three, the surprise your home inspection will never catch, a special assessment. This is the bill that could totally blow up your finances. And I don't want this to happen to you, at least unbeknownst to you going in. It's called a special assessment. Here's how it works. Your HOA dues, you know that, no surprise there. But when there's a big repair coming, maybe it's concrete work, maybe it's windows, maybe it's an HVAC system, maybe it's a balcony, there's going to be a large amount that needs to be set aside in order to make those repairs. But if the association has not been allocating to these deferred maintenance projects, these capital projects, it could throw a wrench into the building's obligation to go get this money, and that's going to get passed down to you, the homeowner, in what's called a special assessment, a large bill that is typically due in a short period of time. And a lot of times, these mandatory assessments, it can be due in a very short period of time, sometimes as less as 90 days. I've seen assessments up to $400,000 per unit owner. Now, yes, of course, that is drastic, but even a $30,000 assessment when you have not been budgeting for that can be an unwelcome surprise. So that $400,000 assessment came from that building in Florida, and each of the unit owners had to allocate and go find $400,000. Picture, you buy your dream condo, you've moved in, you've placed all your furniture, you've painted, you've hung your pictures, and bam, now you have to come up with $30,000, $100,000, $400,000. We don't want those kind of surprises. I specifically do not want them for you. And then there's insurance, and things are getting worse. Condo building insurance has skyrocketed, some from 30% up to 500%. And when the building's insurance explodes, where do you think that's getting passed down? Sure enough, to the unit owners. And it's either as increased monthly dues or as a special assessment. So here's your move. In the next day, ask, are there any special assessments that are expected in the next 12 months? I'd like to review the last 12 months board meeting minutes so I can see what they're talking about, what's to come in this building's future. Because a building that's saving properly is one that's not going to surprise you. It's the building that's kicking the can down the road that's going to hand you a hefty bill. Now let me say this, because I care and I'm licensed, This is how condos generally work. I don't want to go doomsday on condos. That was my first purchase 22 years ago. And it's all very different. The building is different. The condo is different. The insurance bill is different. All the repairs are different. What it possibly needs. Again, I'm talking in general. But big takeaway, get a human to look at your situation. Every condominium building is different. The insurance is different. The projects coming are different. How much they've set aside is different. But I care. I want you to understand what questions to ask. Go in, eyes wide open, so you know that what you have planned for, you specifically, and the building you're buying is a good match. So let's tie a little bow on this. A condo loan is 2 approvals, not just 1. It's you and it's the building. But the rules got stricter in 2026. So the building that passed approval last year may not pass this year moving forward. And remember, we don't want that scary bill, the special assessment, coming unbeknownst to us. You may know things are coming down the road. That's cool, just as long as you've read the minutes. So here's your homework with 3 questions before you write that offer. Number 1, is the building on Fannie Mae's warrantable list? Number 2, can I see the reserve study and the board meeting minutes from the last 12 months? And number 3, any special assessment being discussed? You don't need to become the expert. I just want you to be the woman asking these important questions before you pick out the paint color. And listen, if you're buying a condominium because you just got divorced, I don't want this to stall you out in fear. This isn't me telling you condominiums are bad. Plenty are wonderful and safe and perfectly right. This is me making sure you walk in eyes wide open. Information in its own time is a sense of peace. So tell me in the comments, did you know that the banks don't just approve you, but they approve the building as well? I'm curious. I read all the comments and love to reply to yours. And if you're looking at a specific place, don't guess. Book a call and let's look at that building together to make sure it's a sure thing. And if this helped you, subscribe. I'm in your corner every week. Let's go find you a home that's solid all the way down to the foundation, structural and financial.